Uh, Thank you for coming back. We're with Dale again, and once again he's brought us wonderful sunshine. I suspect it might be because we're coming into summer, but no, we'll give it to Dale. We're still talking about risk, and Dale's going to help us from an advisor's perspective. We're going to look at Fred and John again.
Yep.
How are you going, Dale?
Yeah, good, thanks.
Thank
Kerry.
you for joining us once again.
It's good to be here again.
So, risk strategy for Fred. What would you be thinking of doing for him?
Well, he's obviously in a fairly good position, but that doesn't mean there's still risks available, and obviously some that we need to identify would definitely be some income protection insurance.
Yes.
And obviously trauma insurance would be another one we need to factor in for Fred.
Okay. So life insurance, we assume his girlfriend is living by herself, so she can look after herself. Debt's well under control, and plus the fact if Fred's estate was to go on to anybody else, they'd end up by being pretty well off anyway.
Yeah, looking at his figures, that's exactly right.
So life insurance probably unnecessary for him, as it probably might be for all people who are not in relationships.
Yeah, that's right. You have life insurance if you've got someone that is obviously classified as a dependent, but more importantly, if there's someone that you actually care about and want to be looked after in the case of your death.
Yes, that's right. And probably the same would apply for John. Would we be doing too much different for John?
Not a lot, because obviously he's, as we've seen, likes to play the field and things, so whether or not he actually wants to leave any life insurance proceeds to anyone in particular, it looks at this point in time that he doesn't. We'd obviously have a chat to him about that and see if that's an issue, but at this stage probably not.
Well, he hasn't got much of an estate anyway, really, has he?
Exactly right.
Yeah. I suppose that debts die with you, so even if his estate was negative, it wouldn't probably be too horrific, but of course he still have to be planted.
Yeah, exactly. So there's always costs involved in regards to that. It's a difficult time at the best of times, so you don't want to be worried about costs there.
No, that's right. So in this case, with risk insurance, Fred and John aren't really helping us develop the concepts, are they?
Not a great deal, no.
No. So we need to invent somebody else. So why don't we invent somebody of, I don't know, mid-30s, couple of kids, one at kinder, one at school.
Yep.
Him working full-time, her working maybe part-time. And we'll build on that as we go. So what sort of issues would we have in terms of insurance for these people?
Well, it's a typical case in point with most people out there, and the big thing again, we go back to start for life insurance.
Yep.
We've got one person, the main income earner, the other one obviously is person is relying on that income over a number of years, so life insurance is extremely important.
Yes.
We need to cover obviously if they've got debts in regards to a mortgage, education costs for the kids, because we know that they're getting more and more expensive every day.
Yes.
Funeral costs we've already identified previously with Fred and John, and then obviously income replacement, because if that main income earner is no longer around, the spouse needs that income over a number of years to be able to basically live off. Okay,
let's break it down then. So life insurance, let's give them $300,000 worth of debt.
Yep.
Let's replace $50,000 worth of income. Let's make it simple and give it a 5%. So what we're going to do is invest a sum of money at 5% to yield $50,000 a year.
Yep.
So what are we looking at in terms of a sum of insurance for them, do you think?
I'd say we're over $1 million there, Kerry.
Yeah.
Especially when we're going to get into education costs and those other issues as well.
So say $1 million to provide $50,000 a year.
Yep.
$300,000 to pay off the debt.
Yep.
$200,000 for education.
Yep.
Maybe $100,000 for incidentals.
Yeah, exactly.
So we're over $1.5 million for them, and this is not probably too unusual, is it?
No, it's very typical, and obviously you need to have a conversation with people about how much income they need to live off, and also where they want their kids to go to school and education costs over the longer term.
So then we need to look at total and permanent disability.
That's right.
This episode we're not looking at income protection at all, and we'll come back to them.
Okay.
But so total and permanent disability, what would we be looking at?
Usually it's linked to the life insurance component of someone's insurance needs. So sometimes we can match the life insurance, some other times we might need to reduce it, but usually we do match it with what they need for life insurance.
Yeah, there are some underwriting restrictions in terms of total and permanent disability, and the normal solution is to match the sum insured of their life insurance, isn't it?
That's correct. You can't go above the amount of life insurance unless you take it out by itself, which can double up in costs in regards to policy fees and other issues.
Yeah, well, I guess I'm saying all the time through this episode that in this case, even though I'm encouraging people to do their own work, in terms of risk insurance, often it's better to seek advice because there's no cost
Yeah, exactly.
The cost of the insurance is always the same. And if you deal with the right advisor, they won't charge any more than the commission paid by the insurance provider. So another case where probably advice is better sought. But hey, at the end of the day, that's up to the viewers. If they want to do it themselves, they can. And there should be tools on the website soon to help them do that if they wanted to. So logically speaking then, if someone was to die, there's no, we're in a park with magpies, so I'm just worried about getting attacked. If somebody is dead, there's no care expenses, and yet with total and permanent disability, even though the sum insurance is the same, there's somebody still living that needs care. So how do we deal with that?
We need to factor in, because for example, clients had a stroke, they usually need to remodify their house. So house improvements or modifications. If they're paralysed down one side, you need ramps potentially, or obviously rails and things which need to be factored into the cost.
So you see there's even more expenses. So what we've done is we worked out a sum of insurance for somebody who's dead to keep their family. And what I'm saying is, if somebody's totally and permanently disabled, their family still needs to be kept.
Yeah.
So we actually need a higher sum of insurance, don't we?
Yeah, we can in some instances, that's correct.
So how would we do that, do you think?
Well, the big key would be income protection insurance, because that's obviously replacing the person's income, which gives them that ongoing income coming in for the everyday expenses, where the TPD or total and permanent disabled insurance can be used for those house modifications and other issues.
And this is a case again of making insurances fit, isn't it?
Yeah, they all have a specific reason, so that's the key.
And sometimes by clever design we can cut down the sums of insurance.
Yeah, exactly right. You should always get the right amount of insurance and pay the right amount, but there's no point being overinsured because it will cost you money in the long term. Yeah,
no, that's fine. Okay, look, I think we've done very well with our invented family. Fred and John have let us down quite badly this time. Yeah. Thank you once again for joining us, Dale. Your knowledge is always well appreciated.
Oh, it's good to be here.
Thank you very much for staying with us on this spot. If you join us after the break, we'll be doing a reverse interview on risk, and we'll be joined by Phil, who will be representing you. See you after the break.